You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, welcome back to Volatility Views. We are, of course, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-expanding, ever-exciting, ever-illuminating Options Insider Radio Network. If you haven't had a chance to check them out yet, listeners, run, don't walk. Check out Trading Tech Talk, where we break down all of the cool stuff around Flash Boys and all of the mysteries behind technology in the options and derivatives markets. And also Options Playbook Radio for a nice breakdown of some of your favorite option strategies using some interesting sports metaphors. You can, of course, find all of those wherever you find this fine program. And, of course, while you're checking those out, make sure you check out our Options Insider Radio Network mobile app. You can instantly stream all 100-plus episodes of Volatility Views, download them for offline listening, and then down the road, if you have a question, a comment, you're listening to the show, you hit that @ symbol, you hit that email button there in the app, and you fire off your question, your comment directly to us here on whichever program you're looking for. Just send us your question, your comment, and we'll route it appropriately there. So a lot of cool stuff to check out. The Options Insider Radio Network mobile app. I think you're going to like it. All right, and joining me on the program today, as usual, is my Volatility Views co-host, Mr. Jared Woodard, formerly of Condor Options and Klineman Financial Group, and now man about town and about to embark on his new career in research. Jared, welcome back to the program.
Thanks, Mark. As always, I'm really glad to be with you today.
And listeners, if Jared sounds like he's a little bit mobile, it's because he is. He's on the go right now. He's actually dialing in, ironically, from near our neck of the woods here in Chicago, but dialing in via the magic and mystery of mobile. So if you have a little bit of background noise or hiss, that's why. It's he's not dialing in from his compound there in rural Virginia today. When do you start the new research gig?
I've already hit the ground running over at BGC Partners. We've had some really cool research notes coming out over the past week, and I'm kind of working with some clients that I have existing, and of course anyone who's interested to get plugged in there. So yeah, I'm already kind of in full swing.
And so if listeners want to check that out, do the plug at the top of the show because it is so new. BGCpartners.com, is that where they should go?
Yes.
You heard it here first, listeners. Check it out if you want to catch up on all of Jared's recent research and what he's working on over there. All right, and without further ado, because we're on the clock here, it's time to dive right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. This is, of course, a portion of the show where we break down the week that was from a volatility and a volatility trading perspective. Let's start off, as we are wont to do, in the realm of everyone's favorite, if perhaps meaningless, volatility indicator. Of course, VIX Cash, bandied about quite often, had a bit of a vacillation this week, drifted down to a low of about 1170 or so on Monday, and then hung around the 12 handle for the early part of the week. Of course, breaking through that 12 handle caused a lot of consternation in the financial realm. Are we really headed for a period of hardcore volatility malaise? And we'll get into that a little more down the road a bit here on the show. And then, of course, as we saw a sell-off in the broad markets coming into yesterday's session, and again a little bit today, we're seeing volatility, the VIX Cash, drift up a little bit, hitting a high of about 13 3/4 the other day, and hovering right now as we record this, listeners, on Friday afternoon here, May 16th, it's hovering right around the 13 handle, so it's off a little bit going into the weekend. So, Jared, let's start there. Give us your breakdown of the week that was from a VIX and a general volatility perspective.
You know, one thing that stood out to me this week, Mark, was the relative size of the move in VIX option space, especially on Thursday when the market started to make a more significant move lower. It's hard to, it's also a little bit difficult to analyze some of these changes when you're dealing with low levels of the spot VIX, especially when people look in terms of percentage moves and so on. But one thing that I noticed is that there was a significant move higher in the implied vol in VIX options on Thursday, especially in relative terms. Looking here at say 1 month versus 3 month type comparisons, you saw a pretty significant bid in relative terms in those VIX options, even though we're at very low levels, both in realized and in implied in general. So still a bit of a bid there every time the market makes a meaningful move. And the other thing that's been on, I guess, all of our radars for a while is the divergence in the big indexes, with the sell-off in tech and then now small caps kind of getting hit. All this talk about low levels in VIX, it really kind of masks the carnage that we've seen elsewhere in equity markets.
Yeah, you're right. A lot of the general media has really grabbed onto these low levels in the VIX Cash. A lot of outlets, including our old friend Brendan Conway, who used to write the options column over there at Wall Street Journal, has moved on over there to the blogs at Barron's. He wrote a big piece exactly touching on this called VIX in a Deep Sleep earlier this week, pontificating on how the VIX hit a low of around the 12 handle again this week. And again, bringing up this term that we've discussed with you and other guests in the past, and I find just kind of bizarre, this whole notion of the long-term average of VIX being 20. He beat that drum a bit again. He pulled that out of the CBOE's data. The CBOE is to blame for pushing this out there. They're the ones out there promoting this notion of the long-term average of the VIX being 20, and then the media is running with it. But he beat the drum a lot on that column about how volatility is low when you look at it in relation to this supposed long-term average of 20. I've said my piece on the show in the past a bit about how I think that's a bit of a dubious number. Part of that, of course, is my old school SPX background. I think that's kind of biased me towards VIX being in a range somewhere in the low teens being normal. But what was your take? I know you looked at this article as well, Jared. You probably had some of the same concerns I did about this constant drumbeat of VIX is too low, VIX has to move, VIX has to move.
I think you're right. I think that when people constantly look for mean reversion higher, it's really necessary to be mindful of the carrying costs of that kind of a view. You can a lot of people are concerned about the old metaphor of getting picking up nickels in front of a steamroller. Where you're grabbing really small premium, month after month, and then eventually you take a big hit. But I got to say, over the long term, I've seen just as many, if not more, traders get hit by, death by 1,000 cuts by those high carrying costs associated with long volatility positions, especially if they're sized too big. And this theme about implied vol being too low, I think it fits in the latter category for sure. That you impose, you take on some really big costs if you constantly look for a reversion higher in vol. I mean, I think at the very least, investors have to have a specific catalyst, some specific risk scenario in mind that would drive an increase in equity volatility. And to the historical sort of look back argument, I think that there's a good analog that's a little bit longer term, which is if you take the returns of the S&P 500 going back to, several decades, go back to the 70s or the 60s, get the earliest data you can, and look at the realized volatility in the market. If anything, a longer study suggests that a VIX at 20 is not necessarily a long-term average that we would expect in light of that longer-term market history. You can see cumulative periods in some of that earlier data, before options were even really listed or actively traded, where equities would go for 50 to 100 days at a time, where realized volatility was in the low teens. And in that kind of environment, that kind of an economy, you're just not going to see the same kind of bids for vol that we might have been used to from the 2000s, really. So I think with that longer-term view, and I think a broader economic view of what's happening in the economic cycle, I don't really see any reason to call the VIX too low here.
That's another reason why it just drives me so crazy when I see this drum beating for the long-term average of 20. Again, I suppose I can see the SIBO's mindset behind it, because when VIX gets low, it hurts volume a bit, and people hit all these stories about it. So they want to trump it out there that there is this higher average, and VIX is going to leap back to that level, implying some big move coming down the pike. So you got to load up on VIX now, keep the action, keep the interest alive in VIX when it's low. I can see that from a marketing perspective. But you're right. Historically, it is almost nonsensical to think of it. I mean, the market can sustain a 20 VIX. People forget, they think of the 80s we hit recently, that brief blip, and they think that's the normal frame of reference now. But a VIX of 20, applied volatility of 20 SPX is substantially high. That's implying a significant daily move in the S&P 500 that is just not sustainable over the long term. I think Ewan said it best on the last show when he said people think about this long-term average of 20 and think it could skyrocket back in the near term. And that, of course, is possible, but it could also very easily hang out here for a long time in the low teens. People forget that component and all the drum beating of it's so low, it has to pop. They forget that you could be here for a long time. It just drives me crazy. It seems like some of the interesting stuff going on these days in the volatility analysis space and in the media is certainly going on the blog side of the space. I just mentioned the Barron's blogs, the Wall Street Journal blogs, kind of having a bit of the polar opposite approach to the VIX is too low. They had an interesting quote here, and I'm not a big fan of quoting a lot of these different analysts out there because they like to throw out quotes that are very quote-unquote quotable. This guy's certainly doing that. Nicholas Colas, I don't know him, from Convergex Group, he wrote, "Is it time to ask the question that dares not speak its name, at least on options desks? Are we witnessing the death of volatility?" I love that. I give him points for putting out a quotable quote. That kind of gets to the point we're just talking about. It is very possible to sit here in this volatility malaise, as I referred to it earlier. I'm not going to dare say the sell in May and go away, because I hate that. But we are entering that summer period. It has known to be, shall we say, a less than stellar period from a volatility, a market movement perspective. So it is possible. And all this drum beating of long term of 20, we need to get back there. VIX is mean reverting. It's going to bounce back up there. All of that drum beating, I think, tends to ignore that. I think this guy is actually spot on with the notion. I won't say the death of volatility, but I will say malaise. And malaise could linger for a very long time. Are you in that camp as well? You think we might be hanging out here in this, shall we say, I won't say the 11 handle, but somewhere in the low teens range for quite a while?
I mean, I would define that not as so much. I would define the low teens in terms of equity implied vol as not so much death or morbidity, but normalcy, really. At least for a healthy large economy like ours. I mean, that's ultimately, if you're an investor, you want the economy to be stable and growing, and that's consistent with relatively low implied vol. For all the sophistication of different trading strategies and analytical techniques that some of us get into, I think it's good to step back and think about what we're doing in a bigger picture. And yeah, I think that low teens S&P implied vol is the kind of thing that you want to see, really, for the long-term good of all of us. And yeah, look at it this way. Forget about nominal levels in round numbers. If S&P realized vol is 5 or 6% on a 1 month price basis, and implied vol is still up in the 12, 13% range, that's still a pretty hefty spread. There's lots to do with that. There's a lot you can do with that kind of a relationship. Just because the numbers are nominally low, it doesn't really mean all that much.
Yes, I certainly agree with that sentiment. And of course, even Goldman jumping in on the low VIX, low volatility bandwagon, saying it seems like we're in a period of extended low volatility. The cynic in me wants to say, oh, that's because they're short a ton of vol, but I'll leave that aside and just look at the research note that they put out here, commenting on all their different researchers and the different models, essentially saying the U.S. recovery here and the macroeconomic perspective is really what they're focusing on here. Really, that perspective is leaning towards the VIX malaise, lower VIX type scenario that we're talking about here. They say the tentative U.S. recovery we have had is now over 5 years old, the time when in previous recoveries, equity volatility in particular has begun to shift higher. But a central part of our forecast is that we have more room to grow than in previous expansions, given the depth of the downturn and the sluggishness of the expansion so far. So the key risk, they're saying essentially that means we're going to stay in this low volatility environment. The key risk to this view that volatility will stay low is that this assumption is wrong. So essentially saying the only real driver they see potentially for volatility is this forecast that the economy actually has more room to grow being wrong. Another possible driver they mention on the macro side being unemployment. If unemployment slowed its decline or it got stuck at the current level, we might see some more vol trickling back into the market. And they say because better growth simply did not translate into meaningful lower unemployment, or because inflation risks appeared earlier and pushed the Fed toward earlier restraint. Those kinds of dynamics reflected in a flattening in the pace of decline in the unemployment rate in our models have traditionally driven volatility higher, particularly in equities, on a sustained basis in past cycles. Again, we haven't seen that exhibiting yet. Another reason why they're jumping in to the VIX is low and going to stay low for a while train. Of course, again, the cynic says, hey, they're short a ton of vol, but that's just the cynic. Let's move away from general VIX, look at some of the options. You mentioned the implied movement in the VIX options was pretty interesting this week. Overall, though, despite we had some interesting movements in VIX, the ADV trickling off a little bit. We're down in the 630,000 range. It sounds like a ton on the surface of it, but it actually is down a little bit from what it has been hitting recently. We've seen many days well over 700,000 in recent weeks, and so we're trickling off that a little bit. Of course, that's just an unsustainable level. 700,000 plus VIX contracts a day is a ridiculous amount of volume no matter which way you cut it. And again, not to beat this drum too many times, but we are still hovering in this extended call open interest portion of the spectrum. The call to put ratio extremely high now, 3.3 to 1 if you're one of those people who buys into that indicator. Again, a lot of that could perhaps be reflecting this notion that they're disseminating out there that the long-term moving average is 20. So a lot of people, retail, perhaps even institutional, buying into that fact and loading up on calls even more than normal, prepping on perhaps a move back to the upside here to that long-term quote-unquote average of 20. Also on the VIX options front, we're seeing a little bit of life out there in VXST options. We're seeing right now the open interest around 1,500 contracts, which is pretty decent for a brand new product. A new product that has VIX in it, though, that's a little bit different barometer. People expect anything VIX related to really light up the tape, and we're not really seeing that right now. In terms of ADV, we're seeing numbers around 500 a day. I do have some question about that, though, because the open interest seems to be pretty locked around 1,500 contracts. If they were trading 500 contracts a day, you'd think there'd be a little bit more fluctuation in that number.
Really, when we get a move in the markets, we get a significant uptick in vol overall. I think that's when this product is really going to take off. That's going to be a big catalyst. If there's, whatever the scenario might be, if it's a change in rates or some other risk scenario that comes to fruition, I wouldn't be surprised to see VXST really take off and to attract a lot of flow at that point. But until then, it's a little bit harder to have big expectations for the product. But it's definitely worth watching, and I think that paying attention to the short-term changes in vol at a short horizon is information to be had there for sure.
Yeah, you think if there was a week that there'd be interest in this week would certainly be it. We had quite a range intraday and near term out in VIX land. So if you're looking to play a very near term product, VXST certainly fits the bill. Moving on to another product that we've talked about a lot here on the show, hasn't really lit the world on fire of yet, but it's starting to change that perspective. That is, of course, RVX. We are, of course, joined by our friends at Russell over here on a regular basis on the show. They haven't been on in a little while, but we're still keeping an eye on RVX to see what's going on out there. And we saw a lot of uptake going into January and February. The open interest was pretty sizable. Then it seems like a lot of it came off after February expiration, and then it hovered around 500 or so contracts for quite a while. And the last few weeks, we've seen some life jumping back in to RVX. No doubt a lot of this attributable to the fact that Russell was in the headlines quite a bit. The Russell was moving. The Russell was a leading indicator for a lot of people all of a sudden. The Russell vol in relation to S&P, Russell vol in relation to the NASDAQ became a big story of how that was moving. And of course, that's a perfect scenario to start jumping into a Russell-related volatility product. The open interest has now jumped up, Jared. It's about 5,500 contracts out there, which is pretty sizable for that product, including a couple of big positions. We see, it looks like an 800 lot of either the July 22 combo or perhaps a straddle. I haven't had a chance to dig into the open interest enough to see exactly what went up out there. I'd probably lean towards the straddle side of that fence. And then, of course, we see about 1,500 lot. Looks like the July 26-27 spread went up, a very tight spread, which is unusual. So those alone accounting for a substantial amount of volume right there. The big players are starting to come out in RVX, looks like in the July timeframe.
I think this is definitely one of the key use cases for this kind of product, where you have a significant change in the way that the underlyings are moving, the underlying equity indexes are moving, is a really almost kind of an ideal opportunity for some of these other volatility products. So it's I think it's interesting on its own right, but when you can trade Russell vol against S&P vol or against the NASDAQ, and the underlyings are doing different things, implied correlation in some of these indexes is seeing meaningful differences. These are all reasons I think that are exactly what this kind of product was designed for. So it totally makes perfect sense that you'd see an uptick in volume there, and to the extent that these big indexes continue moving separately, we could see some real growth here.
I know a lot of our listeners also like to play in other products aside from equity volatility, so there has been, surprise, surprise, other things going on in other necks of the woods as well. I know you like to look at the fixed income side of the fence a lot, Jared, and there were quite a few developments out there over the past week, including the 10-year dropping below 2.5% for the first time since June of last year. A lot of people starting to say, really talking about malaise. The global economies are in a bit of a malaise right now, and it's turning to the central banks and these other big entities to really start trying to shock and jolt these economies back into some semblance of life. Hence, this extreme developments we've seen out there in the fixed income land.
Right. So the 10-year made a lot of headlines. It's a kind of an analogous situation, I think, in rates markets right now, at least in the U.S. government space, where on the one side you've got the sort of carry trade, people playing roll down in bonds, kind of crossing their fingers that they don't get a shock that hands them a large loss. On the other side of the fence, you have people who are sort of constantly paying up to keep those positions open, keep paying that carry. And in some ways, I think it's similar to the exact sort of pairing that we were talking about in the VIX space. Maybe one advantage on the rates side of the fence is that we know that at some point, the Fed exit is coming from this zero interest rate policy environment, and it's just a question of timing. That makes the economic data even more important right now, I think, than it has been for the last year or two, where we felt like, it's not so much about what rate environment to expect as tweaks to QE and things like that. Now that we're talking about, the end of QE, the beginning of, forward guidance for higher rate policy in an explicit way, I think that we're going to be even more data centric than we had been in the past as investors. And if you look globally around the world, if you want to look for a cause of volatility, I think that central bank changes in their overall positioning, and the way that's going to affect currencies, and the way that's going to affect rates, markets, and even feedback into equity is it's probably the top scenario on everyone's minds. You've got the ECB really, really talking more aggressively now. Even in Japan, there's a sense that the clock is ticking on Abenomics, and The growth there before the tax cuts went into effect, the GDP numbers that came out recently were very good. So there's still potential, but there's even in Japan the sense that they've got to start showing results for this batch of policies. And so all of these, I think, different risk scenarios could really drive volatility. And in the case of the ECB this week, we already got a taste of that.
And we've talked about international volatility a lot here on the show. We talked about India VIX in particular quite a bit. Our buddy Russell over at the SIBO just went over there to work with those people a little bit. That was certainly the international volatility story of the past week or so. Of course, with the election cycle going on up there, that's been driving vol all over the place. Last Friday, we saw vol getting cut to about 23% after some of the election turmoil was dying down a little bit. But then at the beginning of this week, again, it gapped back up. And for most of this week, the India VIX was trading in the mid to high 30s, which is substantially high. Got up to about 37.1, I believe, at one point, which it's below the record high of 56, which it hit back in May, but still substantially high. And then, of course, now coming into the tail end of this week, now getting clipped yet again, looking at it here, closing down about 12 and a half handles to about 24, 25 again. So vol in India is just on a tear these days. Seems like if you're worried about a vol malaise over here and in the VIX products, then perhaps you should be looking overseas. Which, of course, is surprising because, as we talked about on recent shows, even despite all these high levels out there, the numbers in that product aren't really lighting up the tape. So maybe we need to go over there and start trading it up a little more, Jared, to put some life in the India VIX.
Absolutely. Great idea.
Let's just start an India VIX fund. Let's just table this show and just go start an India VIX fund. What do you say?
Absolutely. I mean,
I'll be the financial backer.
What? Oh.
We are joined, better late than never, listeners, by Mr. Mark Sebastian from OptionPit.com and Swan Wealth Advisors. Mr. Sebastian, welcome to the show.
Thank you. Sorry for the late arrival.
Better late than never. Really quick, since we've already jumped through a lot of our VIX review, why don't you go ahead and give us your take on the week that was from a VIX and a volatility perspective?
You know, I think the big piece that's come out of it is that VIX and NASDAQ VIX have somewhat normalized, and now the big outlier is the Russell. You know, so if I was watching one piece, I'd watch that spread between VIX and VXN has really narrowed to now under 3 points. And RVX still kind of is at a nice premium, but that'd be the one piece that I would point out.
Yeah, we were just talking about RVX earlier, that product actually getting a little bit of life over the past few weeks now with, of course, that premium you're just talking about. People actually looking to be a little bit attracted to it. About 5,500 open interest. It's about 10x what it was just a few weeks ago. So people putting on some trades out there, which is interesting to see, taking advantage of exactly what you're talking about. Looks like we're even seeing some straddles and some other big trades going up out there. So perhaps some signs of life, people starting to trade the RVX, which is an interesting beast in and of itself. Jared, do you have anything else you want to say about India?
Just that, to be honest, I never really understood the cause of those high India VIX numbers. I'm not an expert on policy or anything like that, obviously in India, but my sense is that this election result was telegraphed pretty well in advance, and that it was something that the people were pretty heavily in favor of. So usually we associate in developed markets in the U.S. at least political driven volatility with uncertainty and with huge changes in policy. I admit I was a little bit puzzled by the persistently high levels there, given the sense of almost inevitability towards the end of the election cycle. But it is what it is. I hope that the development over there in terms of volatility products keeps going. In the meantime, like you say, maybe we need to get more foreign investors trading the markets there.
I think you're selling yourself short there, Jared. I turn to you all the time for my domestic Indian political news and commentary.
It's your loss, man.
You have a handle on the Mumbai scene like nobody else. All right, and now it's time to dive into my own personal favorite segment on the show, and I have a sneaking suspicion it's probably Mark's and Jared's as well, because it's your portion of the show. It's time for the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, listeners, welcome to the Volatility voicemail. Like the man said, no shortage of ways for you guys to get in touch with us here on the old program, including the app. A lot of you guys like to take advantage of that these days, including our listener here. First question coming from listener goes by the handle CNans. I'm not sure how to pronounce that, but he writes, Gamma versus Vega scalping. You've discussed Gamma scalping on early episodes as a way to pay for long volatility positions. Isn't it also possible to scalp Vega by legging into spreads intraday, or is scalping a particular activity linked to Gamma trading? Would it be possible to do a show entirely devoted to listener questions? Oh, he adds a second part here. Would it be possible to do an entire show devoted to listener questions? That's my favorite part of the program because I always learn so much from your answers. Not a bad idea there on the second part there, Mr. CNans. Maybe we have so many questions coming in, we probably could devote a whole show to those if you guys were interested in that. As to the first part, we touched on this a little bit in the past on the show. Gamma scalping, of course, for you listeners out there who may not be familiar, is of course a strategy you use to try to offset some of the decay you're paying on a long premium position while you're trying to make money on it. Sometimes it could be the primary way you actually make your return, make your income on a long premium, a long volatility position. But it's necessary to really defend yourself against the decay, and essentially you're just trading against the change in delta that results from your high gamma position. Whereas Vegas, people like to use the term Vega scalping, and it does kind of apply. I don't really think of them as being the same type of thing. Gamma scalping is a very encapsulated thing where you're essentially adjusting your Greek and you're getting back to flat, and you're adjusting down on the bottom and getting back to flat again from a delta perspective. What you're talking about, at least to me, is more just like legging into spreads. I mean, it's still, if you want to term it that, you can call it scalping if you like, but it really is not really, to my mind, the exact same thing. Mr. Sebastian, perhaps you have a different take. What's your answer here for our friend, Mr. CNans?
No, I mean, what he's doing is not. I mean, Vega scalping is kind of what market makers do, right? Where they're kind of dynamically hedging and trying to take advantage of the bid-ask spread. They're just really trading around volatility. I think that what he's doing is, more legging in and out of stuff. So I tend to agree with you, Mark.
Yeah, I mean, you could use Gamma scalping to dynamically hedge, like you said, and then scalp the Vega as a result. So you could use one to lead into the other, I suppose.
Right. Or it's like, I think Vega scalping is kind of like, well, I'm buying something really cheap, and then I'm finding something else that's expensive, and more in the space of kind of volatility swapping than Vegas scalping, if you will.
Yeah, when I think of scalping, I think you have a kind of net, shorter, flat residual position. He's legging into other spreads. That's a whole different position. That's a different beast entirely.
I mean, I guess one other way would be kind of if you own some straddles and kept them delta neutral. As the vol goes up, you're selling straddles, and the vol comes down, you're buying straddles. But that kind of leaves out the concept of option decay, which would make that kind of a moot point.
That would be an interesting way to do it. It'd be pricey, and your broker would love you.
You'd lose a lot of money.
Yeah. There's an educational angle that we could maybe point out here. If you have on your platform, or if you ever calculate option implied vols on your own, take the bid-ask spread for like an option you want to trade. And sometimes it's instructive if you look at those prices in terms of implied vols, the implied vol at the bid and the implied vol at the ask, you can see, depending on how wide the quotes are, meaningful difference. I mean, we usually talk about vol in terms of one number, or if it's an implied vol index like VIX, but keep in mind that the implied vol really is what you pay for or what you sell. And so I think that can be instructive.
Yeah, that's true. People often forget that the bid-ask spread does indeed have a bit of a practical impact on the actual volatility levels that you're trading. They just look at whatever that midpoint level is and say, okay, that's where my vol is, but where you actually trade it is where it matters at the end of the day. We have time for one more here. This is a quick comment from a listener, goes by the handle Sly, and he writes in about last week's show. Hey, Mark, I really enjoyed the Vol Views episode with you and Sinclair. You should do more quant-oriented episodes. That's a good idea there as well, Sly. And I think we're trying to bring in a whole range of guests that cover a wide swath of the volatility space because, quite frankly, we have so many different listeners on this show, some coming in because they've heard about VIX for the first time and want to learn about this whole volatility thing. A lot of them coming on the more high-end side of the fence who are on the institutional trading side, and they want to dive into what you're talking about here, the quant-oriented stuff. And then there's people in the middle of that range as well, a large number of them. So there's a whole spectrum of listeners to this program, which is a great thing. On the other hand, we have to make sure we have guests that are suited to all of them. But you're right, we have had a history of great quant guests on this program, and I think we're going to definitely try to continue that going forward. Hey, we'll bring Ewan back again, too. He was great last time. He's always good for a good quote or two. What do you think, Jarrett? Should we have Ewan back on the show?
Absolutely, every week.
Every week. There we go. It'll be the Ewan Sinclair Volatility Hour. I like it. All right. Unfortunately, we have a bit of a truncated show this week, listeners, so that's about all the time we have. But before we go, as always, I want to check in with each of my cohorts, my partners in crime, to see what they have cooking, what's coming down the pike from them that may interest you until the next time we can all gather together here on the old Volatility Views program. Jared, you mentioned at the top of the show you have, of course, the new gig. Why don't you tease some of our listeners of some of the stuff you're working on over there that they may be interested in?
I came out with a note this week on some people were asking about something a little more fundamental than I usually work on, cash on the balance sheets of a lot of these big companies and what that means for market returns going forward. So we did a little analysis of that, what the predicted value is of some of those economic data series, and then we'll also have a piece coming out next week looking at changes in implied vol and some of the VIX options lately, and finally, I've got a big piece coming out probably late next week on the tech sector and the stuff we've seen this year and how that's changed implied vol in some of these names. There's still, I think, some good, rich premiums to be had in some of the beaten down momentum technology stocks, and so we're going to take a look at that.
Well, that'll be fun to talk about on next week's episode, some of the tech vol and how that stuff is holding up, or perhaps not, out there in some of those names. That'll be interesting. I look forward to chatting about that on an upcoming show. And Mark, I think this is a record. You swooped in the final 10 minutes of the program here, just in time to hit the plug segment. But of course, you get your time to shine as well. What's coming down the pike over there at Option Pit as well as at Swan?
Yeah, well, keep watching those VIX spreads and vol spreads. That could be really telling for what the market's doing. We got a fun day today where you've got kind of S&P down and VIX down at the same time. That's actually, Jared can tell you that's generally kind of points towards some sort of bottom, at least, or some sort of dead cat bounce Monday. At Swan, we're still pushing the Swan Re, and that it's growing. It's going really well. We're doing all sorts of fun stuff. Option Pit, we've launched our chat this week and our special gold. So if you are interested in listening to Andrew talk all day, boy, have I got the place for you. It's called Option Pit.
So if they're not getting their fill of him on the old Options Insider Radio Network, then they, of course, can surf over to Option Pit for a full mega daily dose.
Yep, and $24 for your first month.
There you go, a bargain.
So give it a try.
All right, and on behalf of Jared and Mark, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course for firing off such great questions. Keep them coming. We'll try to get to a lot more of them in the future episodes, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/The Options Insider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.